On a daily basis, gold is overbought. The market is rallying, but gold is overbought, so it's more vulnerable. On a weekly basis, gold is just getting started on its rally, according to a volatility indicator that I use. And on a monthly basis, it's about a third of the way through a bull run. So maybe another 6 months, according to that. The banks are all very bullish on gold. The press is picking up on gold. And so you should be careful, always. But we are headed into the time of year when we have an election. So we have some conflicting information out there, but the gold bull market rallies on a wall of worry.
The gold market has been remarkably bullish, with prices recently surging above the psychologically significant $2,500 level. On Monday, the precious metal rallied again, signaling potential for further gains. This upward momentum is fueled by a combination of factors, suggesting a robust long-term outlook for gold. VinceLanci, a veteran commodities trader and respected analyst in the precious metals sector, offers a nuanced perspective on gold's current position. According to Lanci, while gold appears overbought and potentially vulnerable daily, the weekly charts indicate that the rally is just beginning. From a monthly perspective, Lanci suggests that gold might be only about one-third through its bull run, potentially with another 6 months of upward movement ahead. This analysis aligns with recent observations from Heraeus, a leading precious metals firm. In its latest report, Heraeus highlighted the correlation between rising gold prices and increasing expectations for interest rate cuts. They noted that gold recently achieved a new all-time high of $2,531 per ounce, maintaining its position above the $2,500 per ounce mark. Heraeus emphasizes the role of investor sentiment and interest rate speculation as critical drivers for gold's current performance. The report indicates that managed money investors have amassed one of the most significant net long positions since the COVID-induced rally 4 years ago, totaling approximately 22 million ounces. Despite the overall bullish sentiment shared by banks and the financial press, Lanci advises caution. This prudent approach reflects the complex nature of the gold market, where multiple factors can influence price movements. Lanci characterizes the current gold bull market as climbing a wall of worry. Please tune in for our exploration of VinceLanci's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Now, as to the chart that you're looking at, you'll notice that the bank market-making positions mirror the speculative fund positions. That is not a comment on the banks. That's a comment on the funds. The funds are bullish. They have to buy from someone. They buy from liquidity providers. And in the metals market, liquidity providers are bullion banks because they are the cartel. They have created a cartel over years. The market is not diverse. If you look at other markets, you will see similar patterns. In a market that's speculatively bearish, let's say oil sometimes, you will see the dealers or market makers be constantly long. That would be your citadels, right? But it doesn't show up on this report because it's a more diverse list. So the precious metals market is essentially a cartel that deals with the bulls and bears in the market. The gold market is historically constantly bullish for the reason that gold exists, and therefore the banks must sell to them morally and sometimes legally. And their edge, aside from the information, is in the information that they have and the fact that they have more money than the speculators. Now, the reason that they're having a hard time right now, in my opinion, is because the speculators aren't really speculating. They're physical players who want the gold. And because they want the gold, well, they have pockets that are deep, if not deeper, than the banks. The banks will get out of their positions. The question is at what price? And it's usually when the funds get out of their position. Moving on. Data on deck. Heavy data week. I don't know what to focus on, but I'll tell you what not to focus on. Do not focus on the Fed speakers. Okay? Take my thinking cap off. Focus on PCE on Friday. Focus on durable goods today. Focus on home sales on Thursday. That's it. Let's take a look at the charts. We covered the gold charts very extensively, and I'll just say this in summary. On a daily basis, gold is overbought. The market is rallying, but gold is overbought, so it's more vulnerable. On a weekly basis, gold is just getting started on its rally, according to a volatility indicator that I use. And on a monthly basis, it's about a third of the way through a bull run. So maybe another 6 months, according to that. The banks are all very bullish on gold. The press is picking up on gold, and so you should be careful, always. But we are headed into the time of year when we have an election. So we have some conflicting information out there, but the gold bull market rallies on a wall of worry.
Federal Reserve Chair Jerome Powell has set the stage for upcoming interest rate cuts, marking a potential turning point in the central bank's monetary policy. In his highly anticipated speech at the Fed's annual Jackson Hole Symposium, Powell acknowledged that the time has come for policy to adjust, signaling a clear shift from the recent tightening cycle. While Powell refrained from providing specific timelines or magnitudes for rate cuts, he emphasized that decisions would be data-dependent. The direction of travel is clear, Powell stated, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. VinceLanci interprets Powell's remarks as making a September rate cut inevitable. However, Lanci highlights that the critical questions now revolve around the pace and size of future cuts. The market is grappling with whether a 25 basis point reduction or a more aggressive 50 basis point cut might be necessary. The market's current expectation aligns with a September start to the rate-cutting cycle, despite Powell's deliberate avoidance of specifying a timeline. This sentiment is bolstered by recently released minutes from the July Federal Open Market Committee meeting, which revealed that a vast majority of officials anticipate a September cut to be appropriate, barring any unexpected data developments. Let's get back to the interview.
Gold experienced volatility at first, but ended the week very strong, while oil extended the week lower as geopolitical risk premiums diminished. Geopolitical risks didn't diminish. Geopolitical risk premiums diminished. Last night, overnight, trading showed mixed price action with Hong Kong bouncing back after a weaker close on Friday. Expect a quieter session in Europe today, which we're in the middle of right now. Due to the UK bank holiday, gold and oil are both higher now, however, with a firmer dollar simultaneously, suggesting a return or an exaggeration of Middle East nervousness. The week ahead in context of Friday's speech or event, there was some debate on whether Powell could outdove the market, especially considering the S&P had rallied in 9 of the previous 11 sessions and was nearing the all-time high reached just a month ago. However, initial market reaction was positive. Friday's market reaction was positive, with equities buoyed by Powell's recognition of the unmistakable cooling in the labor market. It's uncertain if this speech will be enough to drive markets higher this week. A September rate cut seems certain now, but the key question is the pace and size of future cuts. In summary, now that we have figured out that Powell is almost definitely going to cut, the market has to ask itself, will it rally because of that, or has it rallied too much? And will 25 basis points be enough, or will the forever greedy stock market need 50 basis points? Essentially, while Powell's comments were dovish, they shifted attention to upcoming jobs reports, making the next non-farm payrolls print critical. I think if you look at that, you'll see that if the non-farm payrolls is normal, then it's 25 basis points. If the non-farm payrolls is very weak, the market will start to expect 50 basis points. I'm not so sure they will get it, but that's what the market will expect. On Friday, the nature of the stock market, as well as the gold market move, suggested a low-quality rally. Now, obviously, it doesn't look that way today. Suggested to make a low-quality rally with shorts outperforming in stocks, indicating that further data might be needed to gain fundamental backing in the stock market. Looking ahead, the next 2 weeks will be slightly disrupted. UK is off today, and the US is off next Monday. So this week, the focus on the equity side will be NVIDIA's numbers, and they will be on Wednesday.
The coming weeks and months promise to be intriguing for both the gold market and broader economic indicators. This could potentially set the stage for significant market movements across various asset classes. How will the interplay between gold prices and potential interest rate cuts unfold in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.